We were talking a little bit earlier,
Yeah.
and you were telling me some stuff about mortgages that I don't think the typical real estate homeowner knows.
Awesome. So when someone comes to us and says, okay, look, I need to buy a place, great. Unless you already got the cash in your pockets, which most people don't, you're going to have to go up there and apply for lending. You're going to have to go lend the money, put your down payment down, and then fund the rest of the mortgage. You can do that in two ways. One, your traditional mortgage, which most people are familiar with. Maybe not to the most granular detail, but have an idea. You borrow money, you come up with your down payment, whether it's your traditional 20% or, there's often topics out there of your non-traditional mortgage. A whole other issue you get, like, the CMHC.
But tell me about what a traditional mortgage is like.
So a traditional mortgage is pretty much this. You're going to come in with your down payment. Ideally, you'd like it to be 20%, but not everyone can get there. So there's some institutions that allow for a little less. But needless to say, you'll be lent an amount of money, a sum, $500,000, $1 million, $800,000, $300,000, whatever it is. Okay. Then over the next, it'll be amortized out, and amortization is the schedule in which you will pay that mortgage off for those tuning in who are a little unsure. And often you'll see something like a 25-year amortization. Some lenders often will sometimes give a 30-year. Very rare to see a 35 or longer. 25 is the most common. Okay. Every 5 years, you'll have to go and renew that mortgage at whatever interest rates are there. And with your traditional mortgage, you're given two options. You can do a fixed mortgage, or you can do a variable rate mortgage. A fixed mortgage says this is the rate that you're paying in interest for the next 5 years, and after 5 years we'll renew, and whatever interest rates are at then, and we'll negotiate it. We'll do something there. A variable mortgage is where it'll give you a little lower interest rate, but it'll float along that 5 years depending how interest rates change. And it'll be based on Canada's prime lending rate. And then all the financial institutions like the banks will kind of wrestle around, and they're always used the first to blink and lower rates. But essentially it's going to kind of float and go along. And it all comes down to, is one better than the other? Well, who knows? It comes down to the individual person. Are you comfortable with saving a little bit and going variable, but you know that interest rates could go up? Or if maybe that's not your thing. Maybe I just want to have the idea, this is what my fixed rate is, and this is what it's going to be for the next 60 months worth of mortgage payments. So it kind of comes down to the individual person, and that requires you kind of maybe sitting down with someone and their education piece being put in there to say, here's how each one works, what are you most comfortable with? Now, a little less known is what's called an all-in-one account. And essentially what this is more designed for the person that A, wants to pay their piece of real estate off as quickly as possible. B, they have pretty good cash flow, okay? Or their cash flow is inconsistent. Someone who is self-employed, for example, someone who is in a volatile workforce that is often going through union negotiations and contract negotiations. The BC teachers had quite a lengthy strike some time back. Okay. Other ones that are constantly kind of up against negotiation battles and say they're off for a while. This gives them the flexibility to make their mortgage payment as big or as little as they want. And the reason it's structured this way is because you have to, in this situation, put down a 20% down payment. It's not a traditional mortgage where you can maybe put down a little less. This is going to be financially underwritten, requiring that you have that 20%.
So the lenders will require a 20% minimum down payment.
Yeah, and the two lenders that are going to offer this stuff are Manulife Bank and National Bank of Canada. So here in BC, we don't see a lot of national banks. You kind of move out east, there's one on every corner. It's like a gas station. They're everywhere. It's a huge eastern presence, but they are a national bank. They're great, and they'll offer these things. Now, how it works is it operates a lot like your checkings account and your mortgage, boom, smashed together like this, like a peanut butter and jelly sandwich. Two separate things that are now one. Every dollar that goes into your checkings account goes towards your mortgage payment.
Oh,
It's very interesting. So say we have a family combined income, as a nice round number, we have a $500,000 outstanding balance, okay?
Okay.
Traditional, let's say your mortgage is $500,000. And that family combined income is $10,000.
Okay.
As soon as that income goes into the bank account, it goes from their balance owing of $500,000, now their balance owing is $490,000.
Oh, so when they deposit their paychecks into their account,
Exactly.
then it goes towards the mortgage right away.
Goes towards a mortgage
So then
just
their
like that.
mortgage is $490.
Exactly, and it's attacking principal first and then not interest.
Oh.
A traditional mortgage is going to be a very interest, say on a $1,500 payment, the majority of that, until you get to about halfway in your mortgage, is all going to interest, where a
Yes.
smaller amount is
Correct.
actually going to pay off principal.
Correct.
That's why it takes 20, 30 years to pay it off.
That's right, that's right.
With this one, it's going to principal first. So say that same family said, okay, $10,000 came in and I went and I spent $7,000 that month. Well,
Okay.
that's fine, it shoots back up. Now your mortgage is sitting at $493.
So 497 is what they're left.
Oh, sorry, yes, $497.
Okay,
Yeah.
okay, 497. Okay.
And then, again, the next month, and it kind of goes like that. And you have an opportunity to build up more equity in your house that's accessible and also pay it off a little faster. But those guys that have a cyclical income, self-employed people,
Yes.
entrepreneurs, people that are in a situation where their income is kind of all over the place. Like they do do a piece of business and then maybe another month or two goes by and then they do another one and they're getting their money in big chunks. These are people that are often feel chokeholded by having a mortgage payment every single month. This allows them to put down chunks as they go. Someone like the teachers, for example,
Yeah.
that big example is ones that were doing that could afford to not actually pay their mortgage for the time they're on, or just pay what they could.
Wow.
Because now their income is not really there, and they're on strike pay, which is obviously their income goes from year to year.
Okay.
Gives them that more flexibility. Now, while that sounds amazing, the one caveat to that is if you're not disciplined in making those payments, because you have the choice to do it or not, you don't want it to become a never plan. Okay? Where your
okay.
house will never be paid off because you never actually made a payment. So
Wow.
you don't
And
want.
then you still got to pay your interest payments, of course.
Yeah, exactly, which is minimal, right?
Yeah.
But it allows for a bit more flexibility. However, it's not for everybody.
Correct.
Okay?
So you're saying, why would an individual choose a traditional versus an all-in-one?
All-in-one.
Or
Yeah.
why would somebody choose an all-in-one versus a traditional?
So a traditional would be someone who just is like, you know what, I just want my mortgage payment to be like this. I know my cash flow, my career.
Very predictable.
It's very predictable. I just do what I gotta do and what have you. Someone whose income on a monthly basis is a little less predictable. Someone who wants to pay it off as fast as they can. Someone who's looking to pay their house off as fast as they can. And every year is doing lumps, whatever the maximum
Lump sum.
allotted lump sum of the traditional mortgage.
Yeah.
That person is actually better off in an all-in-one account. You can just throw it down whenever, there's no penalty. Where the other one, the lending institution, the reason the mortgage industry is so competitive is the lending institution makes a lot of money off mortgages. That's why they penalize you for throwing it down, because now they're looking, oh geez, well that's cutting into
They
my
make
mortgage.
less interest.
Exactly. So where this other one, it's different. Now, not saying that either one is better than the other, but it depends on who is in front of me. So when someone comes into my office and we sit down, whether it's myself or someone on my team, and we sit there and we say, okay, what is actually best for this person? Either one is a solid recommendation if it fits that person's situation. So, if someone has the discipline to be able, to go with an all-in-one account and be able to pay it off faster, great. There's someone that maybe doesn't have that discipline, needs that structure, it's better to have them on their traditional mortgage. Yes, exactly.
Okay. Thanks guys for watching my video. Please subscribe and share with your friends. Email me if you have any more questions. Thank you.